You are listening to KeyStone Stock Talk Podcast, episode 66. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at KeyStocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. This week, in our Your Stock Our Take segment, we take a look at Polaris Infrastructure Inc., symbol PIF on the TSX. The company is engaged in the operation, acquisition, and development of renewable energy projects in Latin America. Currently, the company operates a 72-megawatt geothermal project located in Nicaragua and a 5-megawatt run-of-river project in Peru. A listener asks us what we thought of the company's recent first quarter financials and if the stock offers value at its present level. We have 2 stars for you this week, both from our active client-only coverage. Our first star of the week is Zynex Inc., symbol ZYXI on the NASDAQ, which operates currently in one primary business segment, medical devices, which include electrotherapy and pain management products. The stock is up an astonishing 155% in 2019 alone. Our second star should be no stranger to KeyStone clients. The company is our longest running recommendation and the best performing stock on the entire Toronto Stock Exchange over the past decade. The Boyd Group Income Fund, symbol BYD.UN on the TSX. Boyd released record first quarter numbers this week that smashed expectations, and the stock has jumped another $12 to $14 on the week. I'd like to get right into the show. First off, I'm going to welcome my co-host, Keystone's Senior VP and Senior Analyst, Mr. Aaron Dunn. How are you doing?
I'm doing good, Ryan. Still a little bit exhausted from our whirlwind tour of Canada.
Yes.
I'm doing DIY investment conferences, but I'm doing well. It's nice to get that behind us and get back into the research.
Yeah, for sure. 9 cities in 3 weeks. I'd like to thank all the people who attended the events. I remind you too, for our clients, we'll be recording them and posting them for all current clients. Others can purchase the seminars online. But it was great to get into all of those cities and see, packed rooms and talk to some really great people and, just really get out there and show them how we believe you can construct a simple growth and dividend stock portfolio to beat the markets long term. What stocks to buy, what stocks to avoid, and how many stocks to put in your portfolio, and over what period of time to build that portfolio. All key elements to your DIY portfolio. I think we tried to express them this time succinctly, and then also give them recommendations on individual companies that they can start off that portfolio with too.
Just to start building your portfolio. Yes, yeah. Exactly. And one thing that I love about the DIY conferences is that we don't have a lot of time. We basically have 3 hours to communicate a very important message, and so we really have to focus on just the very key points of intelligent investing and portfolio building. And one thing that you mentioned there, Ryan, is that it's not just about what stocks to buy, but maybe even more importantly, it's about what stocks to avoid. Like just giving people good rules that they can apply, good tools that any investor can apply to avoiding unnecessary risk. And I think that that's one of the big benefits. And then, of course, on top of that, we're also highlighting companies that we think are good investment opportunities and discussing how we approach analyzing those stocks.
Yeah, and it was good fun. Like Aaron said, it's exhausting, but it's it's great to be back in the office. But it is good to get out there. I mean, we met with current clients too as well. It's good to put a face to a voice. Sometimes we talk to them online a lot or on the telephone, but it's great to actually see people in person. Now, there was a couple items of news that came out in the markets this past week that we wanted to look at, just some quick notes. The U.S. government on Friday approved the formation of a new Silicon Valley-based stock exchange, which had come under some criticism earlier or late last year. It's backed by top Silicon Valley figures such as venture capitalist Mark Andreessen. It's going to be known as the Long-Term Stock Exchange, and born out of concern from the nation's tech elite who are frustrated by the public market's focus on near-term profit. There wasn't a ton of details really in the release, so we can't really dig into it a ton, but there was a couple key points. Aaron, I think you noted those, that this exchange was going to try to be a little bit different from some other exchanges out there. Do you want to get into that?
Yeah, for sure. So there's 4 key points, four key differences that they would implement into their stock exchange. They would differentiate it from your typical conventional exchange like the NASDAQ or the NYSE. So one of those is really the focus is to try and create a more long-term mindset for investors, and we believe in theory. I mean, I think that's great practice in theory. Of course, it all comes down to execution. So one of the differences, one of the things that they're implementing is that they would actually scale voting rights with the duration of time that an investor has owned the stock. So, for instance, if you're one of the earlier investors, if you've owned a company for several years, your per share voting rights would be higher than somebody who just bought those shares, a couple of months ago. Another point that they would want to implement, which is something that I think has some potential, is reducing the emphasis on management compensation when it comes to short-term performance. So essentially, there's different ways you can compensate your management team outside of just their salary. You compensate them for the long-term performance of the company as well as the short-term performance. So they would essentially try and remove some of those short-term motivators and focus on more long-term performance drivers. A third point was that they actually would not allow guidance. And I thought that this was very interesting. They would allow long-term guidance, but essentially nothing shorter than a year. They want to have the focus to be on performance greater than 1 year. So no quarterly guidance, no same year guidance, which is interesting. I can't say that I would really be on board with that. I think that the idea of promoting more of a long-term outlook, long-term guidance is great in theory, but it's very difficult for any company to determine what they're going to be able to do in 2 to 3 years. There's so many unknowns. So they talked about having a segment of the financial disclosure that would focus on the long-term growth drivers of the company, and I would assume that this would mean that they wouldn't be giving specific earnings or revenue guidance. Myself, if the company is able to give that information, I don't see why they should not be able to provide it to investors. And then finally, and this is something that was a little less difficult to understand, but they were looking at changing the corporate governance from a structure whereby the shareholders and management team were the main parties involved in determining, in voting on issues and determining corporate governance procedures and standards, and they would extend that to other stakeholders of the company. So, for example, employees or other stakeholders. And just to give an example, like Uber, they would say that Uber drivers should have a say and have a vote. Or with Airbnb, that Airbnb hosts would have a say or have a vote. So I think that the overall idea of having an exchange that is less focused on short-term performance is great, because I think that investors are far too focused on the short term and they lose sight of the long term. But it's the implementation of that I think is going to get tricky. And with all of these 4 things, I can see scenarios where, the intentions are good, where they could actually have an adverse effect on the shareholder return.
No, I'd agree. I mean, that's a great summary there. But well-intended in terms of the thought and the idea behind the exchange, but there can be some unintended consequences, and I think you already talked about that. Giving guidance greater than a year out, we find from management teams is difficult at the best of times. So, I mean, how valuable that guidance would be, it may be minimal value in it. So if you're going to give that guidance and it has minimum value, I'm not sure what's the point of it. And if you have the ability to give short-term guidance, I don't see the real negative in giving it. The dual share type structure or anything like that, generally we don't like. It gives voting control to the few from the many. I don't like those structures generally. And I mean, when you have the initial founders having more of a stake or the initial shareholders having more power, it just creates that type of structure. So maybe well-intended, but the unintended consequences really have to be looked at when they're structuring this exchange. It'll be interesting to watch how it proceeds.
It'll be interesting. And of course, there's other things that, like in terms of management compensation, I support there being more of a long-term element, but you also have to consider the reality that when you're providing an employment package to a top manager, to a top executive, then they're going to compare that to what other options they have. And if it takes 10 years for their options to vest in company A and 3 years in company B, then that's just going to be an advantage for company B. But interesting to see how it turns out. I think that the underlying, the objective is solid.
Of course, yeah. Yeah, and again, the unintended consequences there are you may go to the shorter term compensation and then they are able to attract less optimal management. So, I mean, those would be some of the unintended consequences because you always have competition out there for that management. Now, the other thing, it was a tweet via Twitter that we saw. It was returns over the last 11 years on some of the biggest exchanges in the world. Topping that list, not really surprising, over the last 11 years. It's kind of cherry picking a date going to 11 years, but the U.S. was the market was up 151%. Japan, just second, is only over the last 11 years up 17%. That was Japan. So a massive difference in the returns of these major exchanges. The second place country on that list was Japan, up only 17%. France was up 11%, Korea up 10%, Germany up 9%. This is over 11 years. The UK up 9% as well. China was up just 2%, India 1%. And tying with India there is Canada. Over the last 11 years, the exchange is up only 1%. And the laggard on that was Russia, which is minus 52% over the last 11 years, the entire exchange there. It was interesting to see those returns and how far the U.S. outperformed the rest of the world, essentially, over the last 11 years.
Well, and that's one of the things we've been saying about our U.S. research, and we've covered this in the DIY conferences, is that there's so much drama, there's so much noise in the United States right now, and it just seems like the country is in complete disarray. But if you look through that noise and you look at the business sector, the entrepreneurial spirit that they have down there, it really is unmatched. I mean, the United States has been an innovation engine over the last century, and there's no other stock exchange that has the level of diversification and the breadth of opportunities that they have down there. I mean, we've seen it in our research. There's just companies that you can purchase down there in areas like AI, cybersecurity, all sorts of different areas that just don't even really exist in other parts of the world, especially Canada. I mean, Canada, 1%. I was a little bit suspicious of that, actually, so I decided to confirm that myself, and the numbers do appear accurate.
Yeah, it is amazing to see that, really.
Yeah. Now, you said that this is kind of cherry-picking a date, and it is. So this is basically cherry-picking a date to shortly before the financial crash in 2008, shortly before the big crash. But the Canadian market hit a peak in 2008 of just about 15,000 points. And then it crashed, and then it slowly started coming back up again. Well, it's only about 16,400 and change right now. So we're not that far above our peak. And it wasn't until 2014 that we passed that 2008 peak. And these are just in nominal dollars too. If you actually considered inflation, then we would still be below the peak, right? So it's unfortunate, but it's when you look at how the Canadian stock market is broken down. I mean, resources and financials, about 55% of the market. Technology, such an important sector, almost non-existent at 5%. I mean, on a overall market basis, we have a lot of issues up here, and it's not an attractive diversification.
Yeah, we went through a lot of that in our DIY seminars, and we did a whole seminar on how Canadian investors have to look to the U.S. and we've been talking about that for 2-3 years. I mean, we talked about that for longer, but even in the seminars, just that long. And we always get the question, and yes, it is a valid one, being concerned about the currency. You're buying in Canadian dollars and you're buying U.S. assets, having the currency exposure there. But I mean, this shows you over the last 11 years, just if you would have bought the exchange essentially in the U.S., you'd be up 151%. In Canada, you'd be up 1%. If there was even a 20% negative swing in terms of the currency, you'd be far better buying the U.S. exchange and then the U.S. companies because of the better returns down there. And that's why we see the breadth of companies down there, and we stress you need to have involvement with that segment in the U.S. or just the market in the U.S. just to give us exposure to those type of companies. So we're going to move on to the meat of the show. We're going to go into Your Stock, Our Take. A question comes in. Aaron's going to handle this. It's on Polaris Infrastructure Inc., symbol PIF on the TSX. They recently issued their financials. The question says, can you give me your comments on the results, whether the stock is good value at present? Is there growth in the new run-of-river project coming online anytime soon? This is from Will E., not Willie, Will E. via email. Thank you, Will E. Aaron, I'm going to let you do that. Take that. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
Sure, great, Ron. So Polaris Infrastructure, this is a company we followed for a while, trading at about $12.40 right now, and it yields about 6.5%. So we've had several questions from our clients about the company. It's definitely been a cash flow business. They're a geothermal power producer primarily in Nicaragua. So their main asset is the San Jacinto project, which is located in northwest Nicaragua. It has a capacity of 72 megawatts. So this has until recently actually been their only producing asset, and that has been a major concern to us, is just that country risk. And Nicaragua has been fraught with social unrest recently over the past couple of years, and that's created a lot of volatility in the share price of Polaris. Now, it hasn't affected their cash flow or their asset yet, but of course, whenever you have a situation, a country risk like that is so precarious, investors are always cautious, especially when that's where your only asset is located. But they've recently taken steps to diversify the business, and this is something that we definitely like to see. It makes us more interested. So on October 30th, they announced the acquisition of a Union Energy Group, which owns and develops run-of-river power projects in Peru. So these are generally smaller projects. But what the acquisition came with was a single 5-megawatt project that is producing right now, and 2 late-stage projects, which is El Carmen and Ocho de Agosto. And in total, these 2 late-stage projects are combined to 28 megawatts of power. And the company Polaris is expecting that they're going to be commissioned and producing this year in the third and fourth quarters of this year. So that's good. The acquisition adds about 33 megawatts of power outside of Nicaragua, where they have their 72 megawatt plant there. So that does provide some good diversification. Looking at the recent financial results, they've been very strong. So they put out their first quarter on May 6th. Average production was 64 megawatts compared to 54 megawatts in the previous year. Their revenue was up 26% to $18.6 million. Adjusted EBITDA up nearly 29% to $15.9 million. And they had strong earnings growth, 21 cents per share in earnings compared to 3 cents in the previous year. So very good results, and they have demonstrated that they can produce growth just out of their San Jacinto project alone. So it'll be very interesting to see what happens once they add those other 2 projects as well. But good valuation, trading at about 13.5 times earnings, about 6 times enterprise value to EBITDA. And the balance sheet has improved recently as well, so we don't see them as being over leveraged. My overall assessment is that it's still a higher risk country. based on the existing concentration in Nicaragua. Until we actually see those projects in Peru produce as they're expected, we don't want to put too much weight on that. But I do think it is an interesting story. It pays a nice yield. It's growing. It generates cash flow. They're doing a lot of the right things. So higher risk, but definitely an interesting story.
That's a great summary. Thank you very much. We're going to move quickly to our star number one of the week, our first star of the week. And again, this should be no stranger to KeyStone's clients, as it's been a recommendation for the past 18 months.
From our Stars and Dogs segment, it's time for this week's Star.
Zynex Inc. is the company, ZYXI on the NASDAQ. This is an excellent example of the type of discovery research we provide our clients in the U.S. market. This company was discovered just in late 2017, December 2017, in the $2.75 to $3 range when we recommended it. It was traded on the OTCQX at that point. It has since graduated to the NASDAQ, which is what we like to see. The share price is currently around $7.38, market cap $238 million roughly. Now, the star performance here, the stock is up 45% in the past month, 8% just this week. The stock is up 155% year to date. Now, what does Zynex do? They operate one primary business segment, the medical device market, which includes electrotherapy and pain management. Now, we don't want you to picture the late night TV program with Dr. Ho where their patients have this strange pulsating pad on their shoulders. These are doctor prescribed pain management and rehab devices used often as replacements for highly addictive opioids. What is driving the stock? Well, on April 30th, the company released Q1 earnings, which surpassed market expectations, and the stock is up 35% since that point. Revenues were up 34% to $9.2 million, and net income was up 22% to $2.4 million from $1.9 million in the same period last year. Zynex has been a massive performer over the last 6 months, year to date, and most of the recent earnings release, earnings release has continued that momentum. The company's revenue, net income both had strong growth since we first recommended it in the first quarter of 2018, right at the end of 2017. And the company's balance sheet is very liquid with a net cash position without much debt. They have already issued solid guidance for growth in the next quarter. Revenues to be up over 28% to between $9.5 to $10 million. EBITDA in the range of $2.3 to $2.8 million, and earnings per share around 7 cents. The company has some cost increases in the near term, bringing on some of its new sales reps, but that is an investment for future growth. Now, the financial growth and the big share price gains make Zynex one of our stars of the week. And for our U.S. clients, it has definitely been the star of the year so far.
Just a great example of how you can find an underfollowed, unknown company. I mean, nobody was really talking about Zynex or covering Zynex when we first recommended it. It traded on the OTC, but we liked it because it had the cash flow, the growth, cash-rich balance sheet, and now it's just this year upgraded to the NASDAQ, and that's been a great move for the company and for the shareholders.
Yeah, for sure. And then it trades on the OTCQX, the OTC bulletin board. There's roughly 10,000 stocks there that probably we wouldn't touch with a 10-foot pole, most of them. But the QX is roughly equivalent in terms of disclosure to the TSX Venture in Canada. So we can dig in and review those companies. There's about 450 on that. We go through that twice a year. Zynex was one of maybe 2 companies that made our criteria. And it graduated to the NASDAQ, and it was performing well and continued to perform well. And growth seems to actually be accelerating right now, and that's why you're seeing the share price gains. So that type of discovery research, you can find a company that can be mispriced with absolutely no coverage on it at that point. We can provide that coverage at an institutional grade level, and provide some excellent returns for our clients long term.
From our Stars and Dogs segment, it's time for this week's Star.
Now, the next star, the second star number 2 this week is the Boyd Group Income Fund, BYD.UN on the TSX. The current share price around $163. Market cap is $3.2 billion. For long-term clients, they know we actually recommended this company when it had a market cap sub 20 million, when its shares traded at $2.30 just over 10 years ago. It has paid us $3.75 plus in dividends for a total return of over 7,000% now. But what makes it the star this week? It's up 10% in the last month. Shares jumped about 8 or 10% this week alone. And they're up again another 50% from the start of 2019. So what does the company do and what is driving that? Let's get into that. First off, the business is very simple. Boyd is one of the largest operators of non-franchised collision repair centers in North America in terms of locations and sales. The company currently operates locations in 5 Canadian provinces under the trade name Boyd Auto Body and Glass and Assure Automotive, as well as it operates in 27 states in the U.S. under the name Gerber Collision and Glass. On May 15th this week, the company released its first quarter results that easily beat expectations, leading to the jump in the price we witnessed on Wednesday. This is a continuation of what occurred when the company released its Q4 results, which led to a similar 9% jump in its share price. The results themselves, revenues were up 23% to $557.9 million. Net income was up 17% to $21.4 million. And adjusted EBITDA was up 29% to $54.2 million. Boyd continues to execute on its growth plan. During 2019, the company has added 51 locations while at the same time achieving organic growth through same-store sales in the fourth quarter of 5.3%, which is impressive. If we adjust for one less selling production day in the U.S., same-store sales would have been 6.6% on a per-day basis in the quarter. That is solid organic growth. Now, Boyd has been the best performing stock on the TSX over the past 10 years and has been an absolute home run for our clients, once again hitting new highs this week. With strong growth both in terms of same-store sales as well as the addition of new locations and strong revenue and earnings growth, Boyd continues to show solid promise. The current valuations and prices does reflect this, but it is tough to bet against Boyd's team. The massive share price appreciation over the last couple days and over the course of this year to date and over the past 10 years makes it our star of the week.
Well, one thing I found really interesting, amazing about Boyd is that, with all the growth that they've generated over the past 10 years, you have to ask yourself, well, how much space is there really left to consolidate the auto body repair industry in North America? They have 600 and some odd locations right now across North America. Well, they identify that there are 32,000 shops in North America that could be potential acquisitions. So, that just gives you an idea of how much space there is. And Boyd is one of the largest players in the space and the only publicly traded company. So that just goes to show that there is more space to grow.
Yeah, there's significant runway for the company still ahead of it, which is nice to see. That's going to do it this week. I'd like to thank Aaron for co-hosting with me again this week. Again, I encourage you to keep your questions coming for our Your Stock, Our Take segments. Tweet us, send us on Twitter, send us a tweet, or email us, or through any of the social media channels you can get us, and we'll answer or endeavor to answer your questions every week here. Again, I can remind you that our DIY segment or seminars will be available to current clients by the end of this week, and we'll post those up for purchase for those who weren't able to attend in person by early next week. Thank you very much, and I wish you out there all profitable investing.
Profitable investing.